Welcome back, folks. So the big news is out. The Federal Reserve had a meeting today, September 18th, 2024, and they did what nobody was expecting. Everyone expected a 0.25% basis points interest rate cut, but they totally surprised everyone by announcing a 0.50% basis point cut, which means the Federal Reserve interest rates now run from which was currently at 5.25 to 5.50 interest rate goes down to 4.75 to 5.00 interest rate. So a complete 0.50 basis point downward shift. After the jobs report, there was a high favorability in projections for a 0.25% basis cut, and I covered that in some of my videos as well. But then in the last 2-3 days, there was an immense pressure on the Federal Reserve to announce a 0.50% basis point cut. The reason being because people felt that the Federal Reserve should have cut interest rates one meeting ago, and they didn't. So a lot of the presidents of different banks, Bank of America, Chase Bank, you name it, a lot of the fund managers for different mutual funds, different brokerages, different securities companies were really vocally demanding a 0.50 basis point cut. So Federal Reserve complied, and they did that. So what does that mean for us, for the real estate market? How does it impact the unemployment, the employment? What are going to be its impacts on our personal consumption of private goods like personal groceries and stuff? So we'll cover all that. But first, let me play this little short video clip of Jerome Powell talking about the interest rate cuts going forward for 2024 and 2025. And you'll notice something that now he is playing down the percentages, and then I'll compare you those numbers to what he has said before, and we'll see how they're downplaying and they're projecting an even lower interest rate projections for 2024 and 2025. So with that said, let's go watch the video clip, and then we'll come back to what we're going to discuss.
Risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment.
So as you saw in this video, he talked about the projection for 2024. By the end of 2024, the Fed is projecting an interest rate of around 4.4%, which is, let me show you this chart that I put together, which is downwards from their prior projection of 4.6%. Now for the end of 2025, Jerome Powell is now projecting a 3.4% interest rate for federal funds rate. Previously, he had said it would be at 3.9%. So there again, another downward movement in interest rate projections. And then for 2026, they had previously said it would be a 3.1% range interest rate for 2026 by the end of 2026. Now they're downplaying that to 2.9%. So that is something that they talked about. Now, how does that compare to our everyday life? And one thing that the tool that is in place is called the PCE inflation, which is the personal consumption expenditure. That basically deals with your personal items that you consume on a daily basis, like milk and eggs and personal groceries. So on this chart, you can see that the projection by the Fed is that it will be on a downward trajectory from 2024 all the way towards 2026, 2027. You will see a reduction in price of personal consumptions. How does that interest rate projection compares to our unemployment rate. How is that going to impact our unemployment rate? Like I've explained to you before in the videos, when the inflation goes up, employment goes up and unemployment rate comes down. Now that they're trying to control inflation, they're hoping that the unemployment rate will stay steady at a 4.2, 4.3, somewhere between a 4 and 5% range, and the inflation will remain steady around 2%. It can hover a little bit between 2, 2.5, but they're hoping that these two numbers, these two metrics will balance each other out for the long haul. So what does that mean for those of us who are looking to buy or sell homes? If you are buying a home, or you're planning to buy a home, you need to buy a home now, because as the interest rates go down, the prices will begin to tick up. What does it mean for those of us who are in a kind of tight spot with employment? Maybe you don't have a job right now. The unemployment rate is projected to remain steady, at least for the next 2 years, between 4 and 5%. So good luck, continue looking for a job. And with that said, I thank you for watching the video. If you like the information relevant and useful, please like, share, subscribe, and we'll be back with more relevant information in the near future. Thank you.